One of the most crucial components to successfully planning for your finances is having a budget, no matter how small or large your paycheck is. A budget can be really helpful if you need to save some money to pay down a debt, plan to own a house, or want to go on a vacation, as it helps us understand how much to spend and save based on your own goals and income. While many see budgeting as living frugally and restricting spending, it is really more focused on knowing how much money you have coming in and going out, so you can optimally live off of your means and even plan for the future. Even better, budgeting can be simple by following these basic steps. Keep track of your money. It's important to be aware of money you are making and money you are spending within a certain time frame. This could be weekly or bi-weekly, but the easiest and most often used time frame is monthly, as most large expenses occur on this basis. First, let's focus on money coming in. This step is pretty simple. What is the actual dollar amount you are getting in your paycheck after taxes? Next, think about any other streams of money. Birthday money or other cash gifts this month. End of year bonus? Add any extra cash coming into the positive side of your budget. Fixed costs versus variable costs. Now let's focus on money going out, or total expenses. This step can often be more complicated because of how many different expenses we can have on a daily basis. To break it down into simpler bits, let's think about expenses month to month as either fixed or variable costs, and essential versus non-essential costs. To get an idea of what may count as a fixed versus variable cost, as well as what items may be essential versus non-essential, to put it briefly, fixed costs are expenses that do not change month to month, while variable costs are expenses that may. Essential expenses are necessary to your life, while non-essential expenses are wants that you could live without. It's important to distinguish between expenses in this way because it will help us understand where we can reduce or increase spending if the need arises while devising a budget. Paying off debt. If you find yourself burdened with debt, whether it's from credit cards, student loans, or personal loans, it's crucial to make debt repayment a priority within your budget. Allocate additional funds each month specifically for debt repayment, with a focus on tackling high-interest debts first to minimize the long-term impact of interest costs. Explore debt repayment strategies like the debt snowball method, where you pay off debts from smallest to largest, or the debt avalanche method, where you prioritize debts with the highest interest rates. These approaches can help accelerate your progress and expedite your journey toward becoming debt-free. By actively managing and reducing your debt, you not only free yourself from financial burdens, but also pave the way for a more secure and prosperous future. Take account of your expenses. Now that you have a better sense of fixed versus variable expenses, how can we account for these in our budget? To keep track of your total expenses, add up your fixed and variable costs to figure out your total expenses, or money out. To reflect fixed costs, like mortgages, rent, subscriptions, car payments, or public transit expenses, insurance, etc., in your budget, simply add up the expected payment on each fixed expense you have. Reflecting variable costs like groceries, utilities, clothing, etc., is more complicated as the dynamic nature of these costs means they are harder to expect and budget for. Take a look into your past activity to see what recurring variable expenses you have and what the average expense of each is. If you do not use cash and don't have this information on hand, start keeping track of your spending in a notepad or spreadsheet over the next 2-3 months to give yourself a better estimate of spending. Use those estimates to make realistic assumptions of what you would like to spend on each category in the upcoming month. Building an emergency fund. An emergency fund is indispensable in any budget, serving as a safety net for unforeseen expenses or financial crises. It's prudent to strive for an emergency fund that covers 3 to 6 months' worth of living expenses. Keep this fund in an easily accessible account that earns interest, ensuring it's readily available when needed most. Beyond its monetary value, an emergency fund offers peace of mind and financial security, shielding you from the anxiety and uncertainty that accompany unexpected setbacks. By prioritizing the establishment and maintenance of an emergency fund, you fortify your financial resilience and safeguard your long-term stability. Income versus expenses. Next, Add up your total income and total expenses, keeping in mind that your expenses are negative. After you have your income and expenses added up, there are some key things you may want to consider. First, do you have enough total income to cover your total expenses? If not, it may be time to prioritize essential over non-essentials. That is, what money are you spending on things you do not absolutely need? Are you overspending on clothing, takeout, or entertainment on a regular basis? If you are, it may be good to rethink your spending habits. Addressing overspending does not mean you need to cut out wants from your life, just that it may serve you to cut down. On the other hand, even if you are not overspending, there may be changes you could make to aid in creating a short or long-term savings plan. Devise a budget plan. When crafting your budget, it's crucial to carefully consider your priorities and financial goals. While it may seem like common sense to spend within your means, curbing impulsive or excessive spending can significantly boost your savings, a cornerstone of effective financial planning. For instance, let's say you aspire to save $1,000 for a vacation. If you set aside just $25 each month, it would take a daunting 40 months to accumulate enough funds. However, by allocating $250 monthly, you could achieve your goal in a mere 4 months. This example illustrates the power of strategic saving and the impact it can have on your ability to achieve your dreams. Whether you're aiming for immediate gratification or planning for long-term financial security, your monthly financial goals may vary considerably. By aligning your spending with your priorities and adjusting your budget accordingly, you can make steady progress toward your aspirations while maintaining fiscal responsibility. Common budget mistakes. Some mistakes people often make when it comes to a budget are actually easily avoidable. Underestimating. It's common for individuals to underestimate their spending when creating a budget, which can have detrimental effects such as inadequate savings or accumulating debt over time. To counter this, it's essential to be realistic about your spending habits. Avoid underestimating your expenses when devising a budgeting plan, and instead set achievable month-to-month goals to reduce spending if necessary. Ignoring the problem will only exacerbate financial challenges in the long run. By confronting spending habits head-on and making adjustments as needed, you can establish a more accurate and effective budget that aligns with your financial goals and promotes long-term stability. Not expecting the unexpected. While many individuals excel at planning for expected expenses, they often overlook the importance of preparing for unexpected life events and emergencies. These unforeseen circumstances can wreak havoc on finances if not adequately addressed. To safeguard against such challenges, it's crucial to proactively allocate funds to a savings account on a regular basis. By consistently setting aside money for emergencies, you create a financial buffer that can help you weather unexpected storms without resorting to debt or financial distress. Whether it's a sudden medical expense, car repair, or job loss, having a robust emergency fund provides peace of mind and financial security. Make saving for the unexpected a priority in your budgeting plan, and you'll be better equipped to handle whatever life throws your way. Impulsive spending. If you struggle with impulse shopping, consider strategies to curb this behavior and stay on track with your budget. Shopping with a friend can provide accountability and support, helping you resist the temptation of spontaneous purchases. Additionally, avoid frequenting online shopping sites where impulse buying is common, minimizing exposure to triggers that may lead to overspending. Before making a purchase, take a moment to evaluate whether the item is truly necessary and how it fits into your long-term plans. Consider the practicality and longevity of the product, focusing on its utility rather than fleeting desires. By adopting these mindful shopping habits, you can regain control over your spending, prioritize your financial goals, and make more informed purchasing decisions that align with your budget and values. Forgetting the long term. Budgeting is a lifetime practice that will put you in better shape financially in the short term and long term. Over time, your budget will change as you encounter life changes related to your job, family, and investments. This is why it's important to track your progress, revisit your budget plan, and make necessary adjustments to reflect your present-day circumstances. How to control spending habits? Controlling spending habits requires discipline, self-awareness, and a solid plan. Tracking your expenses is a crucial first step. Writing down every single transaction in a notebook or using an app like Expensify or Mint to monitor your spending. Set financial goals, determining what you want to save for, such as an emergency fund, big purchase, or retirement, and set specific, achievable goals with deadlines. Create a budget, allocating 50-30-20, 50% for needs, 30% for discretionary spending, and 20% for saving and debt repayment, adjusting categories based on your individual needs. Cut unnecessary expenses by identifying areas where you can cut back, such as dining out or subscription services, and replace costly habits with cheaper alternatives, like cooking at home or canceling gym memberships. Practice mindful spending by asking yourself if each purchase aligns with your financial goals, and use the 30-day rule, waiting 30 days before buying non-essential items. Automate your savings by setting up automatic transfers from your checking account to your savings or investment accounts, and take advantage of employer-matched retirement accounts like 401k. Avoid impulse purchases by using cash instead of credit cards for discretionary spending, and remove shopping apps and avoid browsing online stores. Regularly review your budget and spending habits, adjusting your strategy as needed to stay on track. Remember, small changes add up over time, so start with 1 or 2 adjustments and gradually work your way towards developing healthy financial habits. Investing for secure future. Building a secure financial future requires a thoughtful approach to investing. While easy access is key for some funds, high-yield savings accounts and money market accounts offer a happy medium. Certificates of deposit guarantee a return in exchange for locking your money away for a predetermined time. The longer the term, typically the higher the interest rate. For the ultimate safety net, U.S. Treasury securities are backed by the U.S. government and come in various forms, all offering guaranteed returns. The key to long-term wealth building is time. Compound interest allows your money to grow exponentially over time. Mutual funds provide a basket of stocks, bonds, or other assets, spreading your investment risk and offering professional management. Dividend-paying stocks can be a compelling option, distributing a portion of company profits to shareholders and offering steady income alongside the potential for capital appreciation. The key to long-term wealth building is time. Compound interest allows your money to grow exponentially over time. Starting early and consistently investing, even with smaller contributions, can accumulate significant wealth in the long run. Remember, this is just a starting point. Every situation is unique. Consider your risk tolerance, financial goals, and investment horizon before making any decisions. Consulting with a qualified financial advisor can be invaluable in creating a personalized investment strategy for a secure financial future. Budgeting is a fundamental skill for achieving financial success and security. By setting clear goals, understanding your income and expenses, creating a budget, and practicing prudent financial habits, you can take control of your finances and build a brighter future. Remember that budgeting is a journey, not a destination, requiring diligence, discipline, and perseverance. Start today and reap the rewards of financial empowerment and freedom tomorrow. Thanks for watching, and don't forget to like and subscribe to our channel for more insightful tips on personal finance.